Let's have a conversation about Netflix stock as it has dropped 26% over the past 3 months. The primary reason for this sell off is obviously the drama surrounding a merger with Warner Bros. Discovery, the parent company of DC Universe, Game of Thrones, Harry Potter, and many more. When you think of Netflix, you think of a company that has seemingly won the streaming wars over powerful companies like Disney with Disney Plus and ESPN Plus, and even Amazon with Prime Video. However, Netflix is seeking to grow their dominance even more in the space by acquiring Warner Bros. Discovery. This would obviously provide Netflix with the unique intellectual property mentioned before and the studio space necessary to continue to produce their own shows and movies. So, in today's episode, I'm going to look at Netflix and how they become a formidable force in the entertainment industry and the strategy that has gotten them to where they are today. We'll also, of course, dive into the Warner Bros. Discovery deal, the drama surrounding it. Can Netflix afford to take on this deal? And even looking at maybe Donald Trump getting involved in the deal. And finally, we'll finish the video off by looking at the numbers and deciding whether Netflix is a buy at today's price. My name's Jack, and let's get right into today's video. So to start off, I think we have to talk about Netflix by starting in COVID years during the pandemic, as there was a massive streaming wars between Netflix, Disney, HBO, Roku, Amazon Prime Video. They were all warring with each other to gain subscribers to their platforms. However, as we sit here in 2025, it seems like one streaming platform has performed better than the rest, and I think we can all agree that that, of course, has been Netflix. See, Netflix has been able to secure a whopping 301 million subscribers. For reference, their next closest competition would be Disney and Amazon Prime Video, who each have around 200 million subscribers. So it's clear that Netflix has established a sizable lead on the crowd, and the dominance just continues when we start to look at the total TV viewing time for these companies. This metric essentially just measures the percentage of total time that the US spends watching each platform. And when we look at this pie, Netflix makes up 8.7% of the total TV viewing time. This once again dwarfs its competitors like Disney, with being at 4.7%, Amazon Prime Video being at 3.9%, and even like Roku at 2.8%. So essentially, the US spends more time on Netflix than Disney and Prime Video combined, which is insane. But how has Netflix achieved this dominant lead over its competitors? Well, I think we have to start by looking at the users. And users spend on average watching 60 minutes of Netflix per day. And this lines up perfectly with the length of some of Netflix's most popular series. See, Netflix has produced shows like Stranger Things and Squid Games, and these two series alone have been massive hits and have honestly been ingrained in 2020's pop culture. Episodes of Stranger Things last 50 minutes to an hour on average, while episodes of Squid Games last anywhere between 50 to 70 minutes. So you can factor in some of Netflix's most popular films, like K-pop Demon Hunters, which was an absolute hit in 2025 with 325 million views. But that film's length is an hour and 35 minutes, so not too terribly long. So I think that this 50-minute to an hour, hour and a half range has worked tremendously for Netflix, and I think that's what they aim and strive for when producing these shows and movies. It gives users the convenience of watching maybe an episode or two a day, and that's all Netflix needs in order to generate consistent revenue and profits. See, Netflix is starting to build a brand that is becoming part of people's daily routines. Stranger Things and Squid Games and hundreds of other titles on their platform have become must-watch TV. And as a result, people are tuning in every time a new episode comes out for at least an hour, and Netflix is able to sprinkle in advertisements if those users are on their ad tier, which we'll talk about a little bit more later. It becomes even more profitable if users start binge watching, which we know plenty of people do. I'm a victim of it. You're probably a victim of it too at times. But if a show already has multiple episodes or seasons out, users will likely spend more than an hour on Netflix and they can just display more ads over that watch period. On top of that, Netflix has launched a full-fledged assault on the live TV realm. They have streamed WWE Raw events, popular boxing matches like the Tyson versus Jake Paul event, as well as Christmas Day NFL games, which set a record 27.5 million viewers a few weeks ago. So when you're producing the most popular content and you're streaming some of the biggest games in sports, and it's very easy to get at least an hour of engagement from subscribers. Compare the biggest hits of Netflix to the biggest hits of Disney, and you can see that Disney's biggest names in 2025 include Deadpool and Wolverine, Bluey, and Moana 2. Obviously, titles, for the most part, that are more geared towards children. I don't know about you, but the selections from Netflix seem a lot more diverse and engaging than the ones on Disney Plus. We can also look at Prime Video, as their biggest hits were the third season of Reacher, The Wheel of Time, and Invincible. So I just think from a pure popularity test, Netflix is just producing far more popular series and movies. Not to mention, when you factor in the cost of it all, the base subscription for Netflix is about $8 a month compared to Disney's $12 a month and Prime Video's $15 a month. So as a customer, you're looking at it and you can see that Netflix arguably has the most popular content for the cheapest price. And so quantitatively, I think this is how Netflix has won the streaming wars, quote unquote, as they have established a dominant foothold over the traditional streaming competition. It's winning in pure subscribers and has the edge in total TV viewing time. And so, as I said, the path to this position was clear. They created addicting shows and series that people watch. And by owning the most popular shows exclusively on their platform, that alone was able to draw in millions of subscribers. They were even able to win over the cost-sensitive consumer who was on the fence with their $8 a month plan with advertisements. This was far cheaper than what Disney, Amazon, Hulu, or HBO Max offered, and as a result, many people saw the value. So, by building the biggest subscriber base out of all the platforms and creating must-watch movies and series, Netflix has been able to rake in cash from advertisements because advertisers know that their commercials will get the most exposure on Netflix's platform or when they're streaming their live events like the Christmas NFL Day or the Tyson versus Jake Paul fight. And so now I think we have to look at the success of one of Netflix's plans that started as an experiment, their ad tier, which is now responsible for 190 million out of 301.6 million subscribers on their platform. It is by far the most popular choice. And when you break down how much revenue is actually earned per subscriber on the ad tier, you can see that they make $18.72 per user on the ad tier versus $15.49 per user on the standard plan. So it's almost as if Netflix would rather you sign up for their cheapest plan. And it goes back to giving the consumers the cheapest option for arguably the best content, as that's how they build their subscriber base. And by offering you that deal, they're able to sprinkle in ads and boost their revenue. I think it's a truly genius strategy, and I think it's a key factor to why they are winning the streaming wars today. And it's not like this ad tier is a one and done thing. This is going to be a major revenue driver in the future, as they expect it to go from its $3 to $4 billion in revenue right now, all the way up to $9 to $16 billion in 2028 to 2030. So there could be a whole lot more success here for Netflix's ad tier. But before you rush out and buy Netflix, I think it's important that we mention the rest of the story. In fact, I don't think Netflix is in its own stratosphere. Obviously, it's doing great compared to the other streamers, but I actually think Netflix's biggest competitor has an even more dominant position, even above them. And that rival, as you may already know, would be none other than YouTube. Now, let me preface this by saying I don't think YouTube is a direct competitor with Netflix. They are definitely more in an indirect competition. But there's no denying that YouTube has truly rooted its way into society and has become one of the most unique business models around. If we start from a pure content generation standpoint, we can see that Netflix has to fully produce shows like Stranger Things with the actors, with the filming studios, with the equipment, with the producers, everything, the whole 9 yards. High quality blockbusters, but time consuming and expensive. On the other hand, YouTube has millions of creators just producing videos on various topics, ranging from gaming to sports to fashion to tutorials or education. Essentially, YouTube can just create more content for cheaper. Of course, it won't be as high quality as what Netflix produces, but that's not what YouTube needs. See, YouTube has just this dominant presence. Remember our graph here of the total TV viewing time and how Netflix was leading the streaming industry at 8.7%? Well, if we go up a little bit, there's YouTube at a whopping 13.4% slice of this pie. And this slice of the pie has just continued to grow for YouTube. See, 2 years ago, the lead in total TV viewing time was 0.5% for YouTube. Now we can see it has grown to almost 4%. So the lead has just continued to grow. YouTube dominance doesn't just stop there. As we look at total subscribers or monthly active users on the both platforms, we mentioned Netflix 301 million paid subscribers, which once again is great and it's leading the streaming industry. But then you have YouTube, who has a grand total of 2.74 billion monthly active users. And that figure doesn't include China, where YouTube is banned. So roughly 1 in every 3 or 4 people on planet Earth use YouTube on a monthly basis, which is an insane stat. But what is also true is that YouTube is free to use, while Netflix charges an $8 a month fee. This is why I think YouTube and Netflix are more of an indirect competition. rather than direct, because YouTube clearly has a different content selection and it's way easier for users to access. So the comparison is not apples to apples. In fact, Netflix doesn't even list YouTube as a competitor on their official company website. Management has certainly acknowledged the success that YouTube has in the entertainment industry as a whole, but they also recognize that YouTube also kind of helps Netflix with some indirect promotions of their material, as YouTube short videos display various shows or movies that they have on their platform that draw people in. So while I think YouTube has a major place in the entertainment industry and certainly is more popular and used than Netflix, I also just think that their type of competition is different, and I don't think it's a major talking point when you're comparing and evaluating Netflix stock. However, an interesting note is that despite YouTube having 2.4 billion more monthly active users and owning 13.4% of the total TV view time, Netflix is actually poised to surpass YouTube in revenue here in 2026. We can look at the revenue growth rates, and you can see that Netflix posts a figure of 15.65% in 2024 versus YouTube's 14.7%. In 2025, the trend is expected to continue, with Netflix posting a 13.92% growth in revenue versus YouTube's 12.5%. With these strong revenue growth trends and Netflix outpacing YouTube, Netflix is anticipated to generate $46.2 billion in revenue versus YouTube's $45.6 billion in revenue. And I think the main reason for Netflix passing YouTube in revenue goes back to just them operating on completely different styles. As mentioned before, YouTube gains the majority of its revenue by displaying ads. Their revenue primarily comes from advertisers, not from subscribers, whereas Netflix now lives in both worlds with the subscription and the advertising on the ad tier. Now, the next part of Netflix I want to evaluate is, of course, the Warner Bros. Discovery acquisition, the main piece of news that is causing all the volatility in this stock. Now, I think it's important to know how Netflix has operated in the past and why this is so hard for investors to sort of swallow this pill. Netflix is not known for being a company that goes out and makes major acquisitions. This type of merger would be a first for them, and the acquisition is set to cost a whopping $82.7 billion. Obviously, Warner Bros. Discovery has valuable intellectual property like the DC Universe and Game of Thrones, but the real value in this merger is the Warner Bros. Discovery Studios. We discussed this before, but Netflix produces a lot of films and series and has had great success in doing that. Actually, most of their success has become in doing that. This acquisition would further expand what Netflix is capable of producing. And while the benefits of this merger are clear, there are some legitimate concerns surrounding the merge. The first being the terms of the deal. See, Netflix holds a lot of the burden of this deal. If regulators decide that this deal is unlawful or anti-competitive and reject it, then Netflix has to pay Warner Bros. Discovery $5.8 billion out of their own pocket, which would be a massive hit. Chances of this deal at least being challenged are not zero. See, Paramount Skydance has been on the other side of this deal trying to acquire Warner Bros. Discovery, and their CEO is David Ellison, who happens to be the son of the richest man in the world, Larry Ellison, who is the CEO of Oracle. Now, Paramount Skydance has offered way more than Netflix's $82.7 billion bid multiple times, with offers reaching $100 billion plus. But Warner Bros. Discovery has opted to stay with Netflix offer time and time again. I think Warner Bros. Believes that Netflix will be able to utilize their material better and it's less risky than partnering with Paramount as Netflix is more established. This makes sense as Netflix has a strong track record of success. And on top of that, if Warner Bros. Discovery switches for a buyer other than Netflix, then Warner Bros. Owes Netflix $2.8 billion out of their pocket. So obviously an expense they want to avoid, and it would just be easier to just stick with Netflix at this point. But David Ellison claims that if Warner Bros. Partners with Netflix, then Netflix would now own 43% of the total subscription streaming market. He claims that this would be unlawful and that the DOJ should strike it down. Not to mention, David Ellison's father, Larry Ellison, is buddy-buddy with the President of the United States, Donald Trump. It's not crazy to think that emotions and politics could become a major part of whether or not this deal actually goes through as the bidding war goes on over the next few months, especially since President Trump has called out Netflix multiple times before for its woke agenda in TV shows and movies. So that's just one question of whether the deal would even go through, and that's causing a ton of volatility in Netflix's stock. The next question is how the deal would be financed. Netflix doesn't just have $82.7 billion in cash lying around, so this deal will have to be paid out over multiple years. $10 billion of that $82.7 billion is debt from Warner Bros. Discovery. We will dive deeper into this in a bit when we go over the financials, but Netflix doesn't have a history of taking on a ton of debt. This deal is breaking a lot of the core stances Netflix has stood by throughout the years, which leaves investors nervous that they are making a strategic. In addition, current investors in Netflix are concerned about being diluted as Warner Bros. Discovery shareholders are expected to receive $4.50 worth of Netflix stock per Warner Bros. Discovery shares. There's been news that Netflix could be considering an all-cash offer, which would obviously make this point moot, but that's yet to be seen. So there are major questions on how this deal will affect Netflix financially and whether it is a smart acquisition to take on. Will shareholders get diluted? Will they not? There's a lot of questions about this deal. From the legal standpoint, it's totally out of the control of investors, but we can certainly determine if this is a smart move financially for Netflix and answer some of the questions there. And with that, we will now look at the financials to see how this deal would affect Netflix. So when we go to the income statement, we're going to start at the top with revenue. And newsflash, I am not worried about Netflix's revenue here in the future. They rake in $43 billion a year right now and has had a very strong but steady 9.9% CAGR over the past 5 years. We can see that the year-over-year growth, we can see that the year-over-year, it has grown 11%. So it's actually grown a bit faster as of the recent years. And I think it's in large part due to their ad tier success. Netflix has found more ways to squeeze revenue out of their subscribers with the introduction of the ad tier, and it's expected to only grow from here. Combine this with Netflix's emergence into live entertainment and events and the content from the Warner Bros. Discovery merger, I think it's reasonable to expect that these revenue growth rates continue. Next, I always like to see the cost of revenue and evaluate if it's outpacing revenue growth. In short, if revenue growth is outpacing the cost of revenue growth, then the company is generally growing efficiently and margins are improving. If the cost of revenue growth is outpacing revenue, then margins are shrinking, and this could be a major red flag. What we can see here is that Netflix cost of revenue is growing at a slower rate than revenue, and as a result, gross profit is improving. You love to see that. Business as usual for Netflix, A plus there. In fact, gross profit over the past year grew 16%, while its 5-year average has been 14%. So this is a very strong sign for Netflix. Margins are improving, revenue's growing, all good news. Next, I always like to look at a company's research and development expense, especially if they're a growing tech company like Netflix. You can tell a lot about a company's mindset or growth stage by how much they are spending on research and development. And for Netflix, it looks like they are getting more aggressive. Research and development grew 12% over the past year, which is greater than their 5-year average of 9.6%. This is a meaningful uptick in spending, but this isn't necessarily a bad thing. See, Netflix is trying to find ways to expand their moat and research what type of shows or movies might be the next biggest hit. I think this is actually a good move for a company like Netflix to continue to produce and remain the top streaming platform in the world. I don't think Netflix can sit back and be content on what they've already built. So I think this research and development still is a good sign for me. I like to see that Netflix is continuing to research and try to find new ways to grow. And they are doing this in a way that isn't straining their margins, which is a plus as well. This is evidenced by dropping down and looking at their net income. Despite the increase in costs to try and find an edge and grow their already massive business, net income is growing at 19.7%, which is still in line with their 5-year average of 19.5%, an extremely strong bottom line growth. So after looking at this income statement, all I can see is a strong financially sound business. Investors should be happy with performance like this. Growth is accelerating while margins are expanding. When we evaluate their free cash flow, we can see that Netflix has grown free cash flow 4 out of 5 years and has recently grown at 29.5% year over year. The strong growth in free cash flow is why I'm not too financially concerned about the acquisition of the Warner Bros. Discovery deal. Netflix has shown that it is a company that posts strong revenue growth, is growing margins, and is rapidly growing free cash flow. Netflix has it figured out financially. Warner Bros., on the other hand, carries a decent amount of debt, and this has bogged down their business. This debt has severely limited how much they can grow because a ton of their cash is being allocated to pay off its debt rather than trying to drive revenue growth. When I go through these financials, all I can see is strength and positive growth with graphs going up and to the right. Netflix has proven that it is a premier company in the market, and the products it releases continues to captivate its viewers and starting to establish a moat in the entertainment industry. This is a company that you should pay a premium for because it is a high quality business. I think investors have become accustomed to this strong growth by Netflix and these continuous, predictable financial statements, which is obviously what you want as an investor. But Netflix is still trying to grow, and the Warner Bros. Discovery deal is obviously going to bring on some debt and some short-term challenges to Netflix's financial position, which I think a lot of investors are wary of, and deservedly so. But I think this is a good move in the future and long term. I think the financials of Netflix will look way better 10 years from now than they do even today. The content and the studios of this deal are no question a for sure benefit for Netflix, and all Netflix investors should be happy about that. The question, obviously, is how they will handle the financial aspect of it, how they will pay down debt. Will it affect Netflix in the long term? And I just don't see it affecting Netflix in the long term with how they are growing right now, how efficient they have become, the costs they can cut from Warner Bros. Discovery as their synergies overlap. I think this is a deal that is going to work out, and I don't think it should be a room for major concern for investors. That's why at these valuations in the low 30s for price to earnings and at $88 per share, I wouldn't blame you for starting a position in Netflix. I think it's an extremely strong company and it's a good entry point after a 26% haircut to get in on Netflix. What I know is that over the next few months, we're going to get a lot more news on whether the government wants to get involved in this deal and whether Paramount Skydance continues to apply pressure on Netflix by offering higher and higher bids, and whether Warner Bros. Discovery will continue to reject them or not. So over the next few months, I think we're going to see a lot of volatility in Netflix stock, and I'd be extremely interested in buying in the low 80s to even the $70 range. And if you're already in Netflix and it drops down to those prices, I think it's a good time just to load the boat. You rarely get opportunities to buy quality companies like Netflix at these prices. So I think this is a stock where if you're in it, continue to buy down more, lower that cost average. If you're not in it, I think you can wait around and see if you can get it for a cheaper price. This is a quality company, and I think that this would be a good entry point coming up here soon. With that, I hope I hope that you guys enjoyed the video today. As always, please like and subscribe and leave down in the comments what you think about Netflix, what I missed, what we should have talked about more. I always like to see what other people have to say. And yeah, have a great day.